Would you like to manage your emotions so that you don't self-sabotage your Forex trading? Stay tuned, we'll be right back. Hi traders, I'm Stacey Burke from Stacey Burke Trading. Today we're going to be talking about the emotions that cause you to sabotage your Forex trading, or any trading for that matter. The number one reason most traders fail is that they usually do something with their risk management that sabotages their trading. Excessive risk, no stop losses, moving stop losses, averaging into losing trades, you name it. Those are all the things that will destroy a trading account. But ultimately, those are all impulsive and irrational decisions that traders make when they're not emotionally oriented. So we're going to look at the main emotional components that are always out there trying to kill you and your Forex trading. Number one, greed. Greed causes us to take excessive risk because we have an unrealistic expectation on a particular trade of what we think the reward is going to be. Now, I say this in a lot of my videos. One of the greatest lessons I learned was from Brent Penfold, and he talks about being the best loser. A quote from the Phantom, the long-term winner is the best loser. And what he meant by that is that you have to be prepared on every single trade. You don't know what the outcome is going to be, and you can't control what the outcome is going to be. But what you can control is your risk management. And I love what Brent says. He debits his account when he puts an order into the market. He debits his account for the amount that trade will lose if it's stopped out. And then he looks at that amount and the loss and makes sure that he's okay with that. And again, depending on what your expectancy is on your trade system, is that most likely your next trade is going to be a loser. So you need to be emotionally oriented and understand that every trade is just another trade. And if you do that and you apply those rules, you don't have any issues about greed. Okay? Hope. Hope can cause us to not place a stop, and it can also cause us to take an excessive loss. I know, because I've been there and I've done that. We get into a trade, it doesn't go our way, but we have the idea that at some point the market will revert back towards some sort of median price and allow us to get out at break even, or maybe even a small gain. We're not even thinking about possibly taking a small loss. And we see a price that looks better for another fill to average in at a better price, and we don't put a stop loss in place because we don't want the market to accidentally spike us out. And those are usually the trades that end up continuing to move against us and create an even bigger loss. And that's where that trade becomes a hope trade. The trader hopes that it comes back and at least now allows them to get out with a smaller loss. And in a lot of cases, those are the types of trades that keep accelerating because they're filling other on-stop orders, because the obvious stops are where there's other positions to go the opposite way. So another way to eliminate hope out of the equation, use stop losses. Always take the first loss, the best case loss scenario. And again, it's just another trade. Number three, fear. Fear causes us to take small profits because we'll take some losses, we'll take a trade, another loss, trade, another loss, and we start to get a little bit gun shy. And so now we're afraid to pull the trigger. If we do pull the trigger, for me, I'm an end-of-day trader, so you could take that trade, put an order in, but you're checking the market during the day, and you're watching it because you're afraid, and it starts to move into profit. Next thing you know, you're up and you've got a small profit. The price action gets a bit volatile, and now you're afraid of losing that profit. So now you take a small profit, and the market continues to move in the original direction for a large move. So now we've taken a small profit. Now, these are the trades that are possibly going to be the ones that make up for a lot of the smaller losses that have occurred along the way. So again, every trade is just another trade. You need to really focus on that mantra, repeat it to yourself. This is all about probabilities. and execution, just hitting the trades, hitting the trades, hitting the trades, managing your risk. When you've got that opportunity and you want to scale in with size, whatever your rules allow you to do, that's where you can look at padding into a position when you're already into profit and the market's moved in that direction. Fear of missing out, fear of taking profits, fear of taking small losses, all those things, again, it creates a rational impulse of thinking. You've got to go back to being emotionally oriented, focusing on your trade plan, but really fundamentally understanding trade expectancy and money management. Number 4, psychological damage and pain. The emotions that will destroy you and help self-sabotage your trading ultimately have caused me to blow up several small accounts. And there's nothing that's the worst feeling when you've blown up an account. You've got to tell your wife, for me, the hardest part was that I've learned a lot over the years, and it's just a reminder that you're only ever one trade away from blowing yourself up, because as soon as you allow emotion into the equation, you've completely lost touch with what trading's all about. Trading is a business, and it's just about managing risk and trade expectancy. And if you are on the other side of the equation and focusing on the money and the profit and loss, now you're allowing emotion to come into the picture. So if you've not blown up an account, at some point you don't want to have to experience this, because there's nothing worse than lying in bed at night knowing you've broken your rules, you've blown up an account, you've got to start over, you've made the mistakes, you've been really disciplined, and then you allowed that one day to destroy maybe months of hard work. So again, have a plan of preparation, work on your mindset daily, stay emotionally oriented, focus on probabilities, and focus on risk management. Every single trade is just another trade. Emotion has no bearing on any of the outcomes of these trades. You can only control how you manage that trading process. You can't control the outcome. When you understand that's where the trade positive expectancy comes in, that's when you're focusing on the business of trading. So manage your risk, focus on trade expectancy, focus on probability, get rid of the emotions out of the equation, and just remember, every trade is just another trade. There's going to be thousands more. Stay in the game, traders, and enjoy the ride. Thanks.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.